Hey guys, welcome back. Ben here, helping you earn more, spend less, and invest the difference. Now today we're going to be talking a little bit about cryptocurrency, specifically a concept known as impermanent loss. Now this is somewhat of an odd concept that's pretty unique to the crypto world, so I feel like we need to talk about what it is and the risks associated with it. Now, one of the ways people can earn additional money via cryptocurrencies is by providing trading liquidity on automated market making protocols such as Uniswap, PancakeSwap, or Thorchain. Essentially, people looking to trade one type of cryptocurrency for another, let's say trade from Bitcoin to Ethereum, can use these decentralized websites to facilitate that trade with relatively low trading fees. Now, with these types of programs, the assets themselves, the Bitcoin and Ethereum that is being traded, isn't being provided by the company, the website. Instead, that liquidity is provided by ordinary people like you and me. So we might give a market maker like PancakeSwap two different types of our crypto assets and allow PancakeSwap to use those assets to facilitate those trades that people are trying to make. And in return, we collect a portion of the trading fees that the website earns whenever another user tries to swap between those two protocols. Now, in theory, these fees can earn people a lot of money, particularly during times when there is a large amount of trades happening as you collect that fee each and every time you help someone transfer between Bitcoin and Ethereum and vice versa. Now, if we look at the APR quotes from PancakeSwap for a variety of crypto trading pairs, we can see that the interest rates are pretty astronomical, oftentimes 30% or more, and sometimes going well past 100% APR. So, at first glance, this seems like an absolutely insanely lucrative venture, but it's important to realize that none of these APRs factor in this concept of impermanent loss. So what exactly is impermanent loss? Well, the first thing that we need to realize is that the overwhelming majority of these automated market making protocols dictate that in order to earn interest on your crypto assets, you need to deposit an equal dollar value worth of both coins. So for example, if you want to provide liquidity to the Bitcoin Ethereum pool, then you would need to put up, let's just say $1,000. So you would put up $1,000 worth of Bitcoin, and then you would also need to put up $1,000 worth of Ethereum. The dollar value needs to be the same, not the total number of coins of each type, but the dollar value, because currently Bitcoin is, like 15 times more valuable on a per coin basis. But we're talking about denominating things in terms of dollars. $1,000, $1,000. Now, obviously, putting in the same dollar value of coins is going to be super easy when you're first depositing your crypto into this liquidity pool. The problem is that the price of both of these coins is constantly fluctuating. Crypto markets are notoriously volatile. It's not uncommon for coins to either gain or lose 10, 20, 30% or more of their value in a single day. And with all these price fluctuations, that causes havoc on this need for both assets to both have the same dollar amount. So what happens is, behind the scenes, these liquidity pools are constantly swapping around your assets in such a way that the dollar value of the two coins that you deposit into the liquidity pool is always worth the same dollar amount as the other coin you put in. For example, let's just say that you are putting in two different cryptocurrency pairs. You're going to put in $1,000 worth of Bitcoin and $1,000 worth of Ethereum. So on the very first day, when you first put them in, obviously the two value amounts are the same, $1,000. Now, hypothetically, let's just say that the price of both coins goes up by 10%, right? So they both go up by 10%. Well, cool. They're still equal. They're still balanced, so there's no problem. Or maybe they both go down by 10%. Well, you still are balanced. You still have $900 worth of value in each of them. So as long as things move in tandem, it's not a big deal. But when coins move in opposite directions, or one coin increases or decreases and the other one stays relatively flat, when there's those price fluctuations, that's where we get impermanent loss, and it can wreak havoc on your gains. So for example, let's reset back to $1,000 worth of each. Now let's say that Bitcoin is having a good day and goes up by 10%, and Ethereum just is staying flat. So you might think that you have $1,100 worth of Bitcoin and $1,000 worth of Ethereum, but that's really not what you're going to end up with, because as Bitcoin is going up in value, this need to constantly keep these two equations balanced is now offset. You have more of one asset than you have of the other. So what that automated market maker is going to do is it's going to sell this asset, this Bitcoin that is going up in value, and it's going to use those funds to buy additional Ethereum coins. So as Bitcoin is climbing, you're slowly selling and bringing your Bitcoin balance back down and buying Ethereum to bring it back up. That way it keeps a nice even balance. So in this case, if one asset is going up and the other one is just staying flat, you're selling an asset as it's going up in value. So inherently, you didn't fully realize the full potential of those gains because you were selling some of it as it was going up to buy this other asset that really wasn't doing anything. And the exact same thing happens if a particular coin is going down. So for example, if Ethereum is having a bad day and it's going down, once again, now we're not balanced. So we're going to sell some Bitcoin and we're going to buy some Ethereum. So it's going to bring our Bitcoin balance down and buy some more Ethereum. But the problem is, if Ethereum is having a bad day, then it's going to rebalance, but Ethereum's probably still having a bad day, so it's going to keep going down. And then we need to rebalance again, so it's going to sell some Bitcoin to buy some more Ethereum. But as we said, Ethereum is going down. So as a coin is going down, you're continually funneling more money into it and buying a sinking ship. Now, sometimes buying a coin as it's going down in value can be a good thing, sometimes referred to as buy the dip. But that's only relevant if we expect the value of that coin to go back up. But once again, even if the coin goes up, now we're going to sell that coin as it goes up to buy this other coin that's really not going up. So no matter what happens, impermanent loss is going to negatively affect us. It's going to hurt us when a coin goes up in value, and it's going to hurt us when a coin goes down in value. Because when a coin goes up, we're selling it before it hits its price maximum. And as a coin is going down, we're buying it as it's sinking to the bottom of the ocean. So we're funneling more and more money into a sinking ship. Now, in an absolute worst case scenario, if one of these two coins, if the value of it goes to zero, we're actually going to lose both sides, 100% of both sides of our money. Because as one is going down, we're going to sell this one that's doing fine to buy more of this coin that's dropping to zero. So it's going to rebalance, and this is going to keep dropping. We're going to rebalance, keep dropping, rebalance, until eventually there's nothing left. So the more volatile a crypto pair is, the higher your losses are going to be with impermanent loss. So impermanent loss can only hurt you. It can never help you. Now, hopefully, at least in theory, you're earning enough money from these trading fees by providing liquidity to these platforms like PancakeSwap, Uniswap, or Thorchain. Hopefully, you're earning enough fees by letting external users swap between those two crypto pairs to offset this impermanent loss, but it's not guaranteed. If there's not enough trading volume, but there is enough volatility, you could lose money even though a particular website is showing you some insane interest rates for providing these liquidity pools. Now, I'm not saying that providing liquidity to these pools can't be a good thing. Some people can make a lot of money doing it, but you at least need to be cognizant of the risks associated with it. Like I said, the more volatile a crypto pair is, the more you're going to suffer these impermanent losses. So especially when we're dealing with these small, obscure coins that typically have the astronomical 3 or 4 digit interest rates next to it, right? That look so tempting. You can suffer some very significant losses using those two crypto pairs due to impermanent loss. So at least be careful and be cautious of what you're doing and know what the risks are when you're putting your money into these liquidity pools. If you found this video useful, consider subscribing, give the video a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.